Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're looking at Tyson Foods Incorporated, ticker TSN. This stock's been beaten down a lot lately. It's been on a downtrend ever since February of 2022, and it today reached a 52-week low after the earnings, which dropped the stock 3.77% by the end of the day, down to a share price of just shy of $49 a share. When we look at the technicals of what's going on here, we see it trading in a range. It's reached as high up as $95, and it likes to stay above $50. So this drop today, I'd expect the stock to make its way back up above 50 over the next few days. It has every time in the past. And then we'll see if it's able to continue this uptrend that had started, or if these earnings were just so bad that something's changed with the company. That's honestly all that there is to look at here. It's a very range-bound stock, just trending up and down with pretty wild movements at times. Let's get into the fundamentals and see what those are telling us. Here we have the fundamentals for the company. So we see some pretty good compound annual growth rate for the top line revenue, almost 8%. We'd prefer something closer to 10, but above 5 we'll take. Cost of goods is growing just shy of what the revenue is growing, 7.6 compared to that 7.9. The gross profit is growing 9.9%. Net income 16.99, essentially 17. Expenses growing 7.28. EBIT 15.99. Gross profit 1.86. Net profit percentage 8.42. So what we're seeing here is, for the long-term trends, everything looks pretty good. I mean, there's some higher expenses and some lower growth, but the jumps that we've seen in the gross profit and the net profit from 2019 to 2022 are good. Gaining almost a whole % on the gross profit and gaining more than 1% on the net profit. Earnings per share, we see that they're growing their earnings per share very well. This last year was only about 2%, but from 2019 to 2022, on a compounding rate of 16%, it's currently trading at a PE of the mid 5s, 5.5, almost 5.6. Based on its historical performance, we see that the stock trends to be around $11. So knowing that, the trailing 12 months, we'd be looking at something more like 97. But analysts are expecting this year to only come in with $4.34 in earnings, nearly half what they came in last year, which would cut our valuation down to 48.4, right about where the stock is today. Assets, we see some nice growth, 3.6% year over year. Liabilities, we see them going down 3.4%. Love those. Book value, we see a nice positive book value, growing at an exceptional rate. We'll see if they're able to continue this. I mean, it was negative in 2019, kind of low in 2021, and a very good number come 2022. But even with that, the valuation would only be about $24 based off of that book value per share. If they're able to grow it going forward, as they have, which I doubt, I don't think that they're going to double up, almost triple up again, but that would give them a $71 fair value based on the book value. As for free cash flow, this 2022 number is a little concerning. Looking at the trend, they could just be high capital expenditures, which I mean, I believe it is. I've looked at the earnings and I see that they're investing heavy in new machinery, new facilities, and automation. We see a growth of almost 45% from 2019 to 2021, and then a big dip this last year. The share count, they seem to be buying back about 0.5% a year, something that we like to see. They're not diluting our positions. Shareholders' equity is growing at about 11% a year. Even this last year came in right on trend. The dividend, they currently pay $1.92, up from the $1.68 they paid in 2019, which gives them a 3.96% dividend yield. For a dividend like that, based on their historical performance, they tend to be about around a 2.4% dividend payer. So that gives them a dividend value. The market would prefer something around $81.40. I like it where it's at. I prefer something above 3.5, but the market seems to be okay with a lower dividend on this. And then going forward, if they're able to continue growing it at about 4% a year, we'd be looking at something more like 85. The ROE is a little low. It's below the 20 that we look for. It's growing and relatively stable, so it's not a huge deal. I prefer it higher. Like, the margins aren't the greatest. Their gross profit is about 12%, which leaves them with a net profit of 5 to 6%. And here are the historical numbers. And then according to the Lynch formula, this company is incredibly undervalued. That's mostly due to the expected earnings growth based on history, but the fact that it's declining, we do have to take that into account, and it's a rather massive decline. But if they were able to come in with even 1% growth in earnings per share, we'd be looking at almost fair value on the stock, slightly undervalued. Well, with that, let's get into the earnings and see what they have to say about their numbers and why the market is reacting the way that it is. And here we have the earnings. So we see that sales were up, but at the end of the day, they came in at a loss of 4 cents per share. So we'll be able to go through and look at everything and see where this is coming from. We see basically flat sales, up slightly. Operating loss of $49 million, which was down 104% from last year. Adjusted operating income of $65 million, down 94% from last year. A GAAP EPS of 28-cent loss, down 112%. Adjusted EPS of 4-cent loss, down 102%. GAAP operating margin of the company was 0.4% loss, and the adjusted operating margin was 0.5%. So not like what we had seen when we were looking at the historical financials of this company. These are razor thin margins that they're looking at here. They're making some huge investments that are more than the money that they're even bringing in. So here they have it by the segment. So we see they decreased beef prices and the volume decreased. They really decreased pork prices and the volume increased. Chicken, they definitely have pricing power on chicken. 2% raise in the price, 6.4% raise in the volume. International, a 1.6 raise in the price, 0.4 decrease in volume. And it comes down to a total of 3.3% volume change to the positive, 3.2% price change to the negative. So they are decreasing their prices more than they're increasing it. Not quite the same story that we saw last quarter. They have the full 6 months rather than just those 3. And we do see that they had a volume increase of 2.1 when they cut prices by 0.8. In their outlook, they say that they have a goal of $1 billion in productivity savings by the end of 2024, and that they've realized more than $700 million in productivity savings in 2022. And then they have by segment again. So expected margins on beef are between -1% and 1%. Pork, -2% and 0%. Chicken, -1% and 1%. Prepared foods, 8 to 10% margin. So that's where they're really making their money off of. Most others seem to be breaking even. The prepared foods. They're expecting $53 to $54 billion in revenue, so flat, if not a slight increase from last year. Capital expenditures, they want to spend $2.3 billion. Although sales are up, the cost of goods is up even more, and their gross profit is cut down from 1,735 last year to 527 this year, with the cost of goods coming in significantly higher. Ended up with an operating loss of 49 compared to a gain of 1,156 this last year. So they really need to focus on cutting those expenses. Total other income expenses, they made money off that. Bottom line, net income loss attributable to Tyson, 97 loss compared to 829 profit last year. Their assets are essentially flat, a small loss. Liabilities, they don't total them up for us, but we do see that they have significantly more current debt than they did previously. And their accounts payable are down. Their other current liabilities are down, which helps to bring their total current liabilities pretty close to what they were October 1st of last year. Long-term debt is up slightly. Deferred income from taxes is down slightly. Other liabilities is up, honestly, a bit. Shareholders' equity is down from 19,702 to almost 19,400. My thoughts on the company and if the market is justified in this sell-off, I mean, I don't necessarily think so. They did have a loss, so headline probably looks awful, but they're still expecting some slight growth this year, which is good starting off on this front here. I mean, they really need to focus on those expenses, and that's what they say that they're doing. They're trying to cut by $1 billion, and they're trying to automate, bring up those low margins that we see. So I personally bought more. In fact, I made a very risky trade on this. I opened a put credit spread with a $50 strike for next week. So I'm betting that it's going to get back above that $50 price target, back above that support. And I put $250 on the line. And if it is, then I get to keep $105. If not, I lose $145. So this will be an interesting one. I bought $600 worth of shares. The long-term trends, like I said, I see no real issues. Some yellows. The expenses definitely need to be kept in line. But we've seen that on a bunch of companies, and they are the best balance sheet that we've seen. So thank you guys for watching. Please let me know if there's anything else you want me to look at, and I'll catch you next time.